Welcome back to Investor Ideology. Now that we've tackled the income statement, it's time to dive into the balance sheet. Think of the balance sheet as a snapshot of your business's financial health at a specific moment in time. It's like a photograph that captures what your business owns, what it owes, and what's left over for the owners. Ready to explore the balance sheet together? Let's break it down. The balance sheet is divided into three sections: assets, liabilities, and equity. Assets are everything your business owns, like cash, equipment, or inventory. Liabilities are what your business owes, like loans or unpaid bills. Equity represents the value left over for the owners after all liabilities have been paid. You could think of equity as the business's net worth. Let's use our lemonade stand as an example again to make this super easy to understand. First, let's talk about assets. Assets are split into two categories: current assets and non-current assets. Current assets are things we can quickly turn into cash within a year, like cash itself, accounts receivable, which is money customers owe us, and inventory. For our lemonade stand, current assets would include cash from our sales and any lemons or sugar we have left for tomorrow's batch. Non-current assets, on the other hand, are longer-term things, like the actual lemonade stand or cooler we bought to store our drinks. These are the things we use over time to keep the business going. Next up are liabilities. Just like with assets, we have two types: current liabilities and long-term liabilities. Current liabilities are debts or bills we need to pay off within the next year, like what we owe our lemon supplier or a short-term loan. Long-term liabilities are debts that take longer to repay, like a loan we took out to buy a fancy lemonade truck. Liabilities are important because they show what obligations we need to meet before thinking about profits. Finally, let's talk about equity. Equity is what's left for the business owners after paying off all the liabilities. In the case of our lemonade stand, if we've paid for everything and still have leftover cash or equipment, that's our equity. It's the owner's stake in the business, representing their investment plus any profits that haven't been distributed yet. And there you have it. The balance sheet balances, hence the name, because assets must equal liabilities plus equity. By looking at your balance sheet, you can assess your business's liquidity, debt load, and the overall value of your business. It's a critical tool for understanding where your business stands financially at any given time. Ready to check the financial pulse of your business? The balance sheet's got you covered.